Welcome again to Quick Biz Education. My name is Dwayne, and today we're going to be looking at inflation. So this is just a quick revision for you, looking at cost push and demand pull inflation. So let's just jump right into it. And you can see here I have some key terms. What is inflation? Is a sustained rise in general prices. Hyperinflation, like a hyper child, it's out of control. Disinflation is when there is a fall in the rate of inflation, and deflation now is the sustained fall or decrease in inflation. So bear those in mind, and you can always go over those, all right? And you need to know the difference, and you need to study those. So let's move right over into cost push and demand pull inflation. So here we have a simple definition. Well, definitions too. So cost push inflation is when the production costs rise and the producers, they pass the increase on to the customers. On the other hand, demand pull inflation is when the demand for goods and services exceeds the production capacity within an economy. So let's look quickly now at the demand pull inflation. So remember, bear this in mind, is when the demand for goods and services exceeds the capacity of production. So what we're saying is that there are two causes of inflation. One is demand pull. How do we have demand pull? One, if there is an increase confidence in consumer spending habit, and also for businesses. So if there is increased consumer and business confidence, then what you'll find is that there is going to be more spending in the economy. Also, if there is a reduction or a decrease in the interest rate, and I'm just going to grab my pen here, right here. So if there is a decrease in the interest rates, it means then that people will want to spend more, because if they put their money in a bank or on a fixed deposit, then what is happening? They're not going to be getting much in terms of the returns, and hence people would want to spend more. And also on the side of businesses, if they can borrow money at a lower interest rate, then they're going to do that, because I mean, you can borrow more money and you can invest, because you're going to be spending less money in terms of what you pay for the interest rate. Also, if the government increases the spending in the economy, then what you'll find is that you're going to have probably more people getting work in terms of government. The government might be spending more in infrastructure. All of these are factors that will increase the overall aggregate demand. And here we see the equation here for aggregate demand is C, consumption plus the investment plus government spending plus the net export. So if all of these things happen here, where you have a weaker exchange rate, where now the demand for export, people are demanding more, then you're going to find that we will have a shift of the AD curve, the aggregate demand. Yeah, look at it. It's simple. If you were to add these numbers, if we had 2, 1, 2, 1, and then we increase the 2 to 3, the 1 to 2, and we increase all of these components, then we're going to have a bigger number here for the AD curve. So what is happening here is that AD1 shifts up. It is an upward shift or right shift. And when that happens, then it moves the equilibrium from the full place of employment, the full employment level. Now we have a new lever here, which goes over here, and it is showing on this side that there is now an increase in the price level. Okay, so this is what happens when we have a demand pull inflation. What we're saying is that the economy is producing way above its capacity, and there we can see the difference there. Okay, so these are the causes now that might be happening in an economy that might impact on demand pull inflation, shifting the AD curve upward, and then having also an impact on the inflation the price level. Let's move on quickly over to the cost push inflation. Now, the cost push inflation, this is also a way in which an economy might experience sustained increase in price, because now what is happening here is that the cost of production are higher than before. And if that is the case, what you will find is that these manufacturers, these companies are going to be they're going to pass on the cost to the consumers. So if there are higher costs of production in terms of increased wages, increase in the cost of raw materials, increase in business costs, then what you're going to find is that when manufacturers, they have to spend more on their production cost, what you're going to find is that it will impact on how much they can produce. And remember now, the AS curve is the aggregate supply. It represents the producers, the manufacturers in an economy. So if they are going to be spending more to produce, it means then that will impact on how much they can produce, and hence we're going to have this leftward shift, which is showing that there is a reduction in the production level. But when it shifts to the left here, what happens is that this equilibrium now has now moved here, which is also impacting the overall price level within the economy. However, there's also an issue here, because if they are producing less, it's going to impact on the real GDP output, right? How much is being produced. And that also can be an issue when we are looking at cost push inflation. So that's about it. Let's just look quickly at some effects here, and you can always stop the video and you can go over to see the effects. So if an economy is experiencing inflation, then one is going to impact on the cost of living. Two is going to impact on the redistribution of income, and fixed income earners like pensioners, they're going to be affected, right? Borrowers and lenders, they're going to be affected. Investment will also be affected, because I tell you that if you have to spend more to borrow because you're going to pay in a higher interest rate, then chances are you will not do that. Also, it impacts on the reduced competitiveness of businesses in the international market. And a real world example here is Venezuela, where because their inflation is higher, they will not be as attractive as other countries within South America. Also, business cost is an impact, is an effect of inflation. Here you'll find that businesses, they will have to be changing prices because something is not stable, right? So that will impact on the business cost. So that's about it for cost push and demand pull inflation. Okay guys, I hope you enjoyed this video. Subscribe to the channel, share the video, and all the best for your exam. Thanks for watching.